Right now, the market feels slow. Nothing is really moving. Breakouts are failing, and traders are getting frustrated. But this is exactly where the market becomes dangerous. Because when things feel quiet, that's often when a trap is being set. Not an obvious one, not a fast move, a slow one. The kind that pulls traders in before moving the other way. In this video, we're going to break down what a market trap actually looks like, why it forms in sideways conditions, and how to avoid becoming liquidity for it. This is Memes to Markets. Let's get into it. A market trap is not just a fake breakout. It's a shift in behaviour. It's when price gives you a signal that looks correct, but fails. And when that happens repeatedly, traders start to lose confidence. There are two main types: a breakout trap, where price moves above resistance, then reverses, and a breakdown trap, where price drops below support, then reclaims. But the real trap isn't the move, it's the reaction. Because traders act on the signal, and that's where liquidity is created. Sideways markets are not random. They're areas of balance. Buyers and sellers are in agreement, which means the market has no reason to trend yet, but inside that range, liquidity builds above the highs, below the lows, and the longer price stays in that range, the more traders place positions around it. Stop losses, breakout entries, short triggers, all of that becomes fuel. So what does the market do? It moves toward that liquidity, not to continue, but to take it. That's the trap. Let's simplify it. Price sits in a range. It builds pressure. Then it breaks out. Traders see it. They enter. Momentum starts. Then suddenly it stops. Price stalls. Then reverses and comes back into the range. Now those breakout traders are stuck. Their stop losses sit just below. And what happens next? Price moves down, takes their stops, and completes the trap. This happens over and over again in quiet markets. Not because the market is broken, but because it's doing its job. The reason most traders fall into traps is not strategy, it's timing. They trade the signal instead of the context. They see a breakout and assume continuation, but they ignore where price is in the range, how many times the level has been tested, whether momentum is actually increasing. And most importantly, they ignore patience. Because the real move usually doesn't happen on a first break. It happens after the trap. Avoiding the trap is not about predicting. It's about waiting. Instead of chasing the breakout, watch how price reacts after it. Does it hold above the level? Or does it fall back inside? Does it build structure? Or does it stall? The best trades don't come from the first move. They come from confirmation, from failed moves, from reclaimed levels. That's where clarity exists. So right now, if the market feels slow, if nothing is working, if breakouts keep failing, that doesn't mean the market is broken. It means the market is setting a trap. And your job is not to fall into it. Your job is to wait, to observe, and to act when the market reveals itself. Because once the trap is complete, that's when the real move begins. If this helped you understand what's happening right now, subscribe for more clean, no hype crypto insights. This is Memes to Markets, and I'll see you in the next one.